All right, and then let me share my screen. Apollonia, can you just tell me verbally if that is on your screen? All right, thank you. Okay, so this is actually probably one of my favorite chapters, and it's a nice one to end on. There's really, in this chapter, four types of calculations. This is a fun one. Two of them consider the time value of money, and what we mean by that is a dollar today is worth more to you than a dollar that you will receive in 12 months, right? Because that dollar that you get today, you can put into interest-bearing account and it will earn interest and be worth more in a year than getting a dollar in a year. So there's two calculations that actually factor that consideration in, and then there's two calculations that just does some hard calculations, hard numbers. It doesn't factor in the time value of money, the present value, and all of that. And it's just it's a quick and dirty calculation. It's fairly accurate. It's not spot on, but it's fairly accurate. And when you're out on the field and you don't have your calculator or your time value of calculation type of calculators, it will at least give you a rough number. It's not, if you will, correct, but it's darn close. Okay. So we'll just run through some of these and we'll show you just exactly how to calculate this. And so there's two things I think it's important as we go into this chapter. One, that you have your book handy, or you at least have, if you have an online book, that you have, it's Exhibit 5. Exhibit 5 and it's Exhibit 9. That will, no, Exhibit 5 and Exhibit, yeah, I guess it would be Exhibit 9, I think would work too. We might find a better one. But you'll need your books so that we can look at those. I know what I was going to say. It's Exhibit 2 and Exhibit 5. Those two are the ones that we really want to look at. So that was the one thing, is you want to make sure you have your book. And then the other thing is, if you haven't printed off these solutions to these exercises, at least have a piece of paper handy so you can make some notes, because there's a couple things that I want to make sure you identify and you notice between these calculations to keep them straight and not confusing. All right, so having said all of that, let's look at the first exercise. It's on page 1338, and this one is called average rate of return. So you can put that one on your notes. Your heading is average rate of return. And there's two things that we're going to learn underneath that one. It's a simple calculation. So the first point would be, this one does not factor in the present value of money. It does not factor in the present value of money. And then if we look at what we have here on the screen, the calculation is average annual income divided by average investment right here. So you'll see it. So for project A, average annual income, 4,800, divided by the average investment. Okay, now, so makes sense, but let's make sure we understand what it's really telling you. So the average annual income. So if we read in number, well, they actually, do they tell us that? No, they do not. So they tell us that the estimated total income over the useful life is $57,600, 57.6. It's got a life of 12 years. So we don't want to know what the total is. In fact, we don't even want to know what it is per year. We want the average. So that's just taking the average, 4,800 for 12 years each. Okay. Average investment. This one too, you got to see, this is a little goofy. This is very goofy, so you're going to have to make sure you see this. What does it tell you that the amount of the investment is? 55 grand. What is the residual value? 5. Okay, so what's goofy is, I want you to see, here is the cost. This is the residual value. But this is what throws everybody around. It's that plus sign. So let's step back and say, what is the average if there was no residual value? So it had a cost of $55,000. At the end of 12 years, it's worth nothing, 0. What is the average investment then? You would say 55,000 plus, what's it going to be worth at the end? 0. And you would take 55,000 divided by 2. That makes a little more sense to people. But in this case, what we're saying is there's a $5,000 residual value. So it's just as if it was 0. So 55 plus 5, because that's what it's going to be at the end, and then divide that by 2. So there's 2 things, or several things that you're going to put underneath average rate of return. Number 1, it does not include the present value of money. Number 2, we're looking at average income. Number 3, we're looking at average investment, okay? And then the 4th thing I just want you to write underneath there so it stands out to you. It will more later than it will right now. This is the word income. They want average income versus average cash flows. And the big difference is this number right here includes depreciation. So we're looking at, if you look here, average rate of return. We're looking at what is that rate based on income, which includes everything, including depreciation. That's a whole different number than a cash flows number. So in this case, we're looking at Project A has an average rate of return of 16% and Project Z of 15%. That's a lot for this very first exercise, but knowing those few things will help us remember what's average rate of return. And we're looking at income, not cash flows. This is an average number. And because we're using this average of 4,800 per year, you can see we're not calculating the present value of these dollars because we're saying we're not looking at when we received the various annual incomes, not looking at year 1 versus year 2. We're looking at all 12 in one scenario. Any questions on number 1? There's a lot there, but yet it's very, very straightforward. It's a very simple calculation after you just know some of those little differences. Anybody? Okay, and on number 2, again, what they're doing here is they're asking again for average rate of return. And really what they're asking for here is, what are we actually saving? Okay, it's more of a savings than it's a return. So this fabricator is considering an investment in equipment that will replace direct labor. So what they're trying to do is do something that will save labor. The equipment has a cost of $125 with a residual value of $15 and an 8-year life. The equipment will replace 1 employee with an average wage of $28,000 per year. In addition, the equipment will have an operating and energy cost of $51.50 per year. Determine the average rate of return giving effect to straight line depreciation. So do we include depreciation? We do because it's an income number. So what we're trying to do here is what will this save us? Okay, well, savings. So we will not have, this is the $28,000 salary. Then, but that's not all that we're saving, right? We're not just saving all $28,000, or I shouldn't say that's just our only annual income number. We should take out of that the depreciation that's going to be associated with that piece of equipment. Well, it had a life of $125. excuse me, it had a cost of 125 with a residual value of 15. Notice we're doing it like we normally do it, minus 15. That divided by the life of 8 years. So here is our depreciation number minus the 5150 of operating costs, because there's still going to be some costs. So it's not all savings, not all 28. And then we divide that by the average investment. Notice here, 125 plus 15 divided by 2. So we're looking at a rate of return, an average rate of return of 13%. So in this case, we're trying to figure out, what are we actually saving? Well, it's not all 28,000. It's 28,000 less some depreciation that we need to consider, less some operating costs. Those would be reducing those savings. It's not all savings, divided by what is our investment. Any questions on number 2? It's a little bit more involved. Okay, when we get to number 4, what they're trying to do here is, before we move on to our second item for your notes, and it's called, number 2 is called cash payback. Well, before we move to number 5, where we actually figure out what is the cash payback, we have to figure out how to calculate cash flows. Okay, so in number 4, what they're trying to show you here is, what is the cash flow per year? Okay. Natural Foods is planning to invest in a new manufacturing equipment to make a new garden tool. The new garden tool is expected to generate additional annual sales of 5,000 units. The new manufacturing will cost, is expected to have a 10-year life and a 17,000 residual value. Selling expenses related to the new product are expected to be 3% of revenue. The cost to manufacture the product includes the following on a per unit basis. Determine the net cash flows for years, for the first year, years 2 through 9, and the last year. Okay, and the reason they have them in 3 different buckets is they're all the same except for these. Year 1's a little bit different than the last year, and years 2 through 9 are all the same. So in year 1, what's our cash flow? Well, there's going to be a huge outlay of cash of 120 grand. Then there is 5,000 units being sold in each of the years at 18 bucks a piece, so there's 90 grand. There's some selling costs that go along with it. And then there's cost to manufacture. And what's interesting here to see is what is included in that. So look at here. It says, if you look at in your text, the direct labor is $250 right here, $250. The direct materials is $320. That all makes sense. And then there is fixed factory overhead and variable factory overhead. And we're only picking up the 90 cents and not the 240 because the 240 is depreciation. It's a cost, but it does not affect cash flow. Remember, depreciation does not affect cash flow. And what we're trying to do here is calculate cash flow. So the cost to manufacture these things that we're actually going to have to write a check for will be the 250 plus the 320 plus the 90 cents, or 660. 33 grand. So in year 1, we're going to have a negative cash flow. In year 2, since we don't have this, we're going to have a positive cash flow. And in the last year, years 2 through 9, but then the last year, we're going to have it all the same again, except for we get that $17,000 residual value back. We get that $17,000 back. So in the last year, the 10th year, we're going to get $71,300. So what we're doing in number 4 is nothing other than making sure we know how to calculate cash flow. Okay. Number 5, if we look at cash flows, it says in number 5, cash payback. So now we're going to put this all underneath your cash payback notes. Jane's Clothing is evaluating 2 capital proposals, each requiring an investment of $975, and each with a 7-year life and an expected cash flows of $1,050,000. Location 1 is expected to provide equal annual net cash flows of $150,000, and location 2 unequal. Well, what's realistic? Unequal, correct? But nonetheless, they have two scenarios. Location one, it's pretty simple. You just take 975, the investment, divided by the cash flows, tells you it'll take 6.5 years. Very straightforward. Cash payback is the easiest. 975 divided by 150 is 6.5 years. Location two, we're going to actually have to figure it out. Well, we get 275 in year one. Year two, we get 225. That's a total now of 500, plus another 180, 680, plus another 175, 855. In year five, another 120. Well, ding, ding, ding. Look at that. Perfect number, 975. So location two, it will take 5 years to pay itself back. Cash payback does not include, so one point, it's point number one, it does not factor in the time value of money. Point number two, it's the simplest. I mean, let's be honest. It's just looking at how long does it take, and it's paying itself back. So no calculation. It's just how many years does it take to pay itself back. Okay. Keep in mind, if there's another point you want to put underneath cash payback, this is, we look at cash flows, not income. Cash flows. Any questions on number 5? So now we've looked at the two non-present value methods, average rate of return and cash payback, neither of which factors in the time value of money. Quick and dirty, right? You can go out and you're going to buy a piece of equipment and they tell you the savings that it will cost, the savings it will generate for you, X, will pay itself back over 10 years. Well, you just take the savings, you know what the savings are, you know what the cost of this equipment is, so you take the cost divided by the savings, it'll tell you, yeah, it'll pay itself back in 6.5 or 5 years. All right, number 7. Before we move on, any questions over the first two? Okay. Number 7 is the first one. It's on net present value. Okay, net present value. And it's pretty straightforward. If you set it up this way every time, be consistent in this way, it will be straightforward for you. Okay, so number 7, it says the following data are accumulated by this company in evaluating the purchase of $150,000 worth of equipment. Notice what they do there in the book. They give you 2 columns, net income and net cash flow. And they do that because they want you to be able to figure out which should I be using. Do I look at net income or do I look at cash flows? And they're going to give you both columns for all the exercises, so you can say, well, I know I'm supposed to look at the income line, or I need to look at the cash flow line. Well, with net present value, letter A, assume that the desired rate of return is 15%, determine the net present value for the proposal. So what they say by the desired interest rate is we need to earn 15% on this proposal or we are going to reject it. So our hurdle is 15%. And after this class, for most of you who are going into business administration or accounting, you're going to take a finance course. And that's what we're talking about there, is that hurdle. That do we or do we not accept this? And it's going to be based upon, is it going to meet our definition of what we think is a good investment? And in this case, they think it's 15%. Okay? So in number 7, on your notes underneath net present value, you can write number 1. This method considers the time value of money. This method considers the time value of money. And number 2, we use cash flows, not net income or income. We use cash flows. All right, now, if you have your book with you, if you look at page 1317, way at the bottom, Exhibit 2, it is the present value of a buck. All right. So what you could say is this. You look at the book there, that yellow box, Exhibit 2, and then in fact, let's just look at the highlighted number there, 0.712. And what it says is the interest column is 12% and the year is 3. So what that says is this. If you take that times, let's just take that times 1,000, okay? 1,000 times 0.712. If I invested, and 1,000 times 0.712 is 712, right? If I invested $712 today and not touch it, in 3 years at 12% interest, it will grow to $1,000. Or you can say it this way. How much is $1,000 worth to you today if you will, how much is $1,000 worth to you if you will receive that $1,000 in 3 years? Well, today it's worth $712. Let me throw a different angle at you. Which is worth more? $712 today or $1,000 in 3 years? And the answer, it's technically, well, I would have to agree with you. I would take the 712 today, but technically if things don't change and it's 12% and you don't touch it, 712 today is equal to $1,000 in 3 years. So one is not more than the other. Now, you know what I'm saying? Now there is that phrase your grandparents probably use. I can't even think of how it works. A bird in the hand today is worth more than, what is it, 3 in the bush or something like that. I forget how it goes, but basically what they're saying is if you get that money today, then you know you have it versus the expectation that you're going to get it in 3 years. But throwing that all aside, what they're saying is if you receive $712 today or $1,000 in 3 years at 12%, those amounts are equal. Anybody have questions on any of that? Please, by all means, say I would prefer that you explain this again, or this doesn't make sense. It's exactly right. So, you know, every year I'll have someone ask, so do we have to memorize this? Well, of course you don't. But those are those charts that the whole finance world uses. You can buy the calculators that have them in there. Those TIs, Texas Instruments, they're already in your calculator. And this is what we're talking about, where the first two methods, the average rate of return and the cash payback, you can be out in the field and you don't need to have some chart. You just calculate, okay, this is my investment divided by the savings, X amount of years it'll pay itself back. It doesn't calculate the time value of money, but it's quick and dirty and it's good. This is a much more precise, exactly the right answer, okay? And of course, you would have to do this in your office. If you look at page 1317, that's a one-time deposit. That's the $1,000 in 3 years, okay? Now, if you look at page 1319, that's the present value of an annuity. So what is that? That is this. If I put $1,000 into my savings account each December 31st for the next 10 years, doing it 10 times every December 31st, what will that grow to? That's a different calculation than what's on page 1317, where we say, what do I earn if I put $1,000 in the bank today, don't touch it, and what will it grow to in 5 years? one time, versus on 1319, the present value of an annuity, where annuity is a string of payments. But the important thing to remember with Exhibit 5, or this annuity payment, that string of payments needs to be exactly the same. So it needs to be $1,000 every year for 5 years. As compared to, I could put $1,000 in there this year 1. I could put in $1,200 in year 2. I can put $900 in year 3. I can put in $1,500 in year 4. That doesn't work. So if you can do 1,000 every year exactly, you can use Exhibit 5. If we go back to my scenario where it's 1,000 in year 1, 1,200 in year 2, 900 in year 3, then if you look here, that's what's going on here in exercise number 7. These are annual cash flows, but they're different every year. So we cannot use Exhibit 5. What we're going to use is Exhibit 2. And notice what we're doing then is we're going to have to calculate it out every year for all 4 years underneath the present value of a lump sum. So what we're going to do is in year 1, we're looking at 15%. So if you go to your book, look at the 15% column. Year 1 is 0.870. Year 2, drop it down, 0.756. Year 3, 0.658. Year 4, 0.572. Make sure you see this in your book. Then you do is you calculate it times each of the 4 years of cash flows, and you get what we would call the present value of those cash flows. So let's talk about that. So what is $80,000 worth today that I'm going to get in a year? So it's January 1. What is $80,000 worth at December 31st? It's worth today $69,600, because as the interest grows over 365 days, it will grow to 80 grand based on 15%. 65,000 is worth 49,000, and all the way down. So the nice thing how they lay this problem out, and this is how you should always do the net present value calculations. The net cash flows, all the cash flows is 235,000. That's a lot. However, it's deceiving. I'm going to get this at the end of year 1. I'm going to get this at the end of year 2. I'm going to get this at the end of year 3. But if the question is, what are all these cash flows over the next 4 years worth today? It's not 235,000. Because of the time value of money, it's worth 174,000 today. Because we want to look at that in the light of, we have to put in $150,000 to buy this piece of equipment. And based on the present value of these cash flows that we're going to get, we have a net present value of $24,000. All right, let's step back here one more time. So if they told you, look at year 1, you're going to get 80,000. Year 2, you're going to get 65,000. Year 3, 50. Year 4, 40. That's 235,000. Well, hey, of course that makes sense. It's going to cost you 150 to purchase. It takes 235,000 back to you in cash flows. That's a great deal. Well, yeah, it's a great deal. The problem is I have to write the $150,000 check today, but yet I will get the 235,000 over the course of the next 4 years. So we're not comparing apples to apples. We're writing a check for 150 today. I want to know, what is my 235,000 worth today? So knowing that I'm going to get that 235,000 over the next 4 years, I need to bring those dollars into today's dollars. into today's dollars, that's $174,000. It's still a good deal because we still ended with a positive net present value of $24,000. So by going through this calculation, we've now determined that this is a good investment because the net present value of our cash flows based on 15% is a positive $24,000. So letter B, it just asks, I gotta look here again and push to that page. Letter B, would management likely be, yes. Why? Yes, because it's a positive 24,000, which means based on our hurdle of 15%, we got there. Now, let's say that this was 200,000. Well, then this number is negative, and that means our cash flows based on 15% didn't get to a positive net present value. So we want to at least be zero, where this would have been 150, this is 150, and this is zero. And if it is zero, that means we absolutely were spot on to our 15%. If it's greater than zero, it means we have earned 15% and more. If this is a negative number, it means that the earnings were less than 15%. I shouldn't say earnings. If it's a negative number, it would mean that our hurdle of 15% was not met. We were earning something less than 15%. There was a ton there. Somebody has to have a question, I'm certain of it. And maybe there's so much there you don't even know how to ask a question, and that's fine. Anybody want that reviewed again? Maybe what I could do is let's go to another one, and I'll probably solidify some of those same ideas again. Actually, let me look at here. All right, well, we'll do number 9 here, and then we'll look at 14 and we'll solidify it too. So number 9, it just reads, this hotel is considering the construction of a new hotel for $50 million. The expected life is 25 years, no residual value. The hotel is expected to earn revenues of $30 million. Expenses, and it includes depreciation, is $23 million. They want 14%. Determine equal annual cash flows. So before you do anything, you got to be able to calculate cash flows. And that's why we did that one exercise, know how to calculate cash flows, because net present value is on cash flows. All right, well, I want you to read this. So annual revenues we know is 30 million. So there's our revenue, but then how much expense? Well, it says annual depreciation expense. So we got to get the depreciation out of that number, correct? We got to get depreciation out of the expenses, and the expenses are 23 million, okay? So if we have a $50 million hotel, it has a 25-year life, that is 2 million of depreciation each year. So knowing that all the expenses is 23 million, taking away 2 million of depreciation is a cash flow of expenses of 21 million. Okay, so then that means 30 minus 21, we have 9 million of cash flows every year. Comparing it to this one, we had different cash flows every year. This one, which is extremely unrealistic, is 9 million every year for 25 years, 9 million. Knowing that, which is really nice, is then we can look at Exhibit 5. the second one, because that's an annuity. It's 9 million every year for 25 years. Now you can do it one of two ways. You can either go to chart exhibit 5 and do one calculation, or you go back to exhibit 2, and exhibit 2 unfortunately does not have a 14% column, but let's say it did. You would have to calculate 25 times 9 million times that factor for year 1, 9 million times that factor for year 2, and you get to the same total as if you did it one time in the annuity table. So if we go to the annuity table, interestingly enough, there is not a column for 14%. So let me tell you where you can get that number. Oh, it says it right here. Appendix A. So if you go to the back of your book, Appendix A, way at the book, end of the book, those charts, all those interest tables, those are the ones you got to memorize. So you see there on pages A2 through A5. So A2 and A3, that's the present value of a lump sum. A4 and 5 is the annuity. And if you looked at the annuity, is where you would get the factor of 6.87293. Looking down the 14% column, all the way down to 25 years, 25 periods, 6.87293. I hope you all are looking with me to these exhibits or the appendix, because, okay, good. The reason is I don't want, it's very redundant, and I realize that, but when you get to the test, I don't want that to be the first time I was like, oh gosh, I don't know which one I'm supposed to look at. So if you do that, you take the 9 million times that annuity, you get 62 million. Well, this one again is going to tell you based on the cash flow going out today versus the 9 million for 25 years and bringing it into today's dollars, 62 million, we have a positive net present value of 12 million. We would accept this project because it got to our 14% hurdle and we got a positive net present value. Questions on 7 and 9. Okay. Let's look at number 14. Hang in there. So let me just clarify it a little bit more than what you had said. So if it is a number that, let's say this, if there is unequal cash flows every year, unequal, meaning they're different every year, you will have to use Exhibit 2, the present value of a lump sum, the present value of a dollar. When I say lump sum, I mean of a dollar, meaning that you'll have to calculate it every year. If you get equal cash flows every year, 30,000, 30,000, 30,000, 30,000, then you can jump to Exhibit 5, the present value of an annuity, because the definition for these charts of an annuity is the same dollar amount to be received at the same time every year. We didn't talk about that, but we will in this chapter always assume the amounts that we receive is on the same day every year. Because if you can about imagine, if you get 30,000 on January 5, and the next time you get a payment is for 25,000 in March, and then the next time you get a payment of, $16,000 in February, that screws up all the calculations because interest is going to be earned at different times. So to use the annuity table, Exhibit 5, it needs to be the same dollar amount every year at the same time. I don't know, did that help you out, Apollonia? Yeah. So let's look at number 14, and what we're going to do is we're going to jump right to letter C, and then we'll go back. But number 14, it says Spanish Railroad is considering acquiring equipment of cost of $1,250,000. Look here on the screen, $1,250,000. The equipment has an estimated life of 8 years. No residual value so no residual is expected to provide, and they give it to you. Thank heavens. We don't have to calculate depreciation. We don't have to do any of that. It just says cash flows, 312. Present value of annual net cash flows, 312. It's the same every year. So then you can go to Exhibit 5 based on 12%, 8 years. 12%, 8 years is a factor right here, 4.968. So I'm going to get 312,500, and do this with me with your calculator. 312,500 times 8. That's 2.5 million. That's great, but it's not worth 2.5 million because I'm not going to get 2.5 million today. I'm going to get 312,500 equally over the next 8 years. And by taking all of those years and moving it all into today's dollars, what is that worth? So what the calculation is, remember we started off the class today, I am going to give you $1 today, or I'm going to give you $1 in 12 months. What's worth more? Well, he said the $1 today. Well, it's in this scenario here, if I'm going to get $1 in a year, what is that $1 really worth today? The dollar that I will get in 12 months or 24 months or 36 months, what is that worth today? And today, the 312,000 I'm going to get for the next 8 years at the end of every year is worth, not 2.5 million, 1,552,000. Looking at that, based on the 12% factor and the cost that we're going to outlay today is a net present value, a positive net present value of $302,000. So what does that tell you? It tells you we have met the definition, we have met the hurdle of 12%. How much over 12%? We don't know. We know it's over because it's a positive number here. If this number here was 0, that would mean we hit it right on the mark, 12%. This number was negative, just like the positive, we could say we don't know what it is, but we know it's less than 12%. So even though this looks very much smaller, this setup, it's exactly the same, right? Just like here, it was exactly the same. Cash flows, the factor, the outflow 50 is 12. The cash flows, what it's going to cost, and then where do we sit? Any questions on letter C? So in number 14, what they're asking for is 3 things. Net present value, which we just did, and then the average rate of return and cash payback. All right, well, let's do the letter B first, the easiest of all 4 of them, cash payback. Cost of the investment, $1,250,000, divided by the cash that we're going to get every year, 4 years. It will take 4 years to pay itself back. Cash payback, easy. Letter A, what's the average rate of return? Remember, rate income. So how much depreciation is there? Well, it's a $1,250,000 cost as an 8-year life. So 1,250,000 divided by 8 is 156,250 in depreciation. So 312 is the cash flows minus the depreciation out of there is 156,000. I wish those two numbers were not exactly the same. It's unfortunate. This 1,250,000 divided by 8 is ironically 156,250. So when you take 312 minus 156,250, you get 156,250. That's unfortunate because that's misleading. So you take the expected yearly cash flows, back out that depreciation is 156,250. So then what is our income? 156,250. Divided by the average rate. Well, what did we say the average is? The cost at the beginning. What's the thing worth at the end? 0. So 125 plus 0, 125 divided by 2. The rate is 25%. Questions on number 14. Okay. Oh, I know, because you see this right here and you think, oh, that's what this is. Well, it's 312 minus this number here is 156,250, which happens to be, they should not have done that. Should have made it 7 years, so it would have been a different number. But okay. I noticed Hank's already checked out because his mom is recording it now. She just sent me a text saying Hank went back to bed. Okay, so I honestly think I would like to have gone a little bit further, but I think that's probably enough. I mean, I think there's a lot there. Do any of you have questions before we call it a day? I would tell you this, please review these before we get back together on Monday. It'll make it a whole lot better for you just to look at these again and add to your notes, making sure you see the differences. And then on Monday when we get together, we'll do some more. We'll do 16, 19, and 21. 16, 19, and 21. You should be able to do 21 yet today. You should be able to do half of number 19 because it's the present value and the fourth type. You should be able to do problem 1A with no problems. You should be able to do problem 2A with no problems. And you should be able to do half of problem 4A. And when I tell you where you can't do some of it is on Monday, you can certainly give it a whirl and try, and that would be great. But on Monday, we're going to look at the fourth method, the internal rate of return. And let me tell you what that is here real quickly. So let's look at this right here, net present value. This makes sense. It's all, after you look at it, it's pretty straightforward. But remember when I said to you, if this number here would have been 1,250,000, let's say, 1,250,000 minus 1,250,000 is 0. If it was 0, it would tell us it met exactly 12%. And we'd accept it because it said it needed to be 12%, and that's all good. But what the internal rate of return does for us is to say, okay, it's not 0, it's a positive 312. How much is it actually? Is it 12.1%? Is it 15%? Is it, what is that number? Or let's say that this was a minus 312. Well, does that mean that the actual rate was 11.9% or is it 8%? Because if it was 11.9%, we could say, well, gosh, that's basically 12%. We're okay with that. We're not okay with 8%, but we're okay with 11.9. But right now, we don't know what is the actual rate. We just know it's more than 12%. And I can tell you this, before you even take the exam, you're going to get 3 questions that'll say, or 3 options, 302, 500. Is that 12%, more than 12%, or less than 12%? That'll be a multiple choice question. And internal rate of return will tell us 302,500 is actually 14%, or whatever that number is, I don't know. So that's what we'll learn on Monday, how to do that. So if you could, try to look at the last 3 exercises, 60, 19, and 21, and problem 1A, 2A, and 4A. And problems 1A, 2A, and 4A have, some of them have 2 of the methods, some of them have 3 of the methods, and it kind of compares. So that's what we'll do on Monday. Let me stop sharing my screen here a minute. All right, I don't know if I'm back or not, but unfortunate for you guys. How does that sound like a good plan? Everybody? So it's a good chapter. If you just go through it well, it'll make sense and whatnot. So I'll let you go, but that's what our plan will be on Monday. I'll make sure also that I'll have our review sheet for you. And like I talked about on this past Monday, so we'll do this again on the 4th, May 4th, Monday. And then we will actually have, the next 2 class sessions, May 6th and May 11th, open, where you do not need to attend. We won't be going over any new material, but probably what I'll do is on those days at least allow for you to call in or log in, and if you got questions and whatnot. So those 2 days will be given to you more for just to get caught up from the end of the semester with other classes, my class, whatever. And then we'll not really have any class those last 2 days. So you can prepare yourself for your finals the following week. Any questions for me? Anybody? Longer day today. Boy, sorry about that. All right. Perfect. Yep. You bet. And if you guys just want to give it a whirl and try those exercises for Monday, that's fine. And then we'll go over those in great detail on Monday. And then we'll spend as much time as we need to make sure we understand them. And then we can also review them again on the 2 days that we don't have class. So we can review and go over anything from 22, 25, and 26. So, all right. You guys have a great day. Thanks for logging in. All right. See ya.